So, how's everybody doing out there today? My name is Lee Fjord, and thank you for joining us for another edition of Make It Happen Multifamily's monthly live webinar. Yes, this is live, being recorded. So, if we have any like technical difficulties here in the middle, please don't hold it against us here, anybody. So. Uh, we're gonna, keep it going here as we have more people joining us slowly but surely. But give a big shout out, if you're here, jump in, ask questions. This is an interactive webinar experience where you have the opportunity to be able to ask questions, make comments. Boos are not suggested. But my name is Lee, and I am the founder of Make It Happen Multifamily. It is my thought leadership platform. Our objective is to be able to educate real estate investors and teach them about the benefits of investing in larger commercial size multifamily real estate projects. And how do we do that? We do that through Green Forest Capital. Green Forest Capital is my real estate syndication company. I have multiple partners that are with me on that real estate investing company, but I am kind of like the spearhead, the tip of the spear, the front man, whatever you want to call it, for Green Forest Capital. And my objective today is to teach you passive investors, teach you how passive investors get paid on real estate deals when they invest passively in multifamily real estate syndication deals. This could be applied to any asset class, of course, but our main focus here today is on commercial multifamily real estate syndications. So once again, please feel free to jump in and ask questions. Would love to hear from you along the way. It makes it a lot more fun for the audience who eventually watches this in the future, and for our active audience here that are watching us or attending live for our webinar. So distribution splits, returns explained. Yes. How do passive real estate investors get paid when they invest in real estate syndications? My name is Lee Fjord. I've owned over a thousand apartments. I used to be a property manager, then became a real estate broker with a company called Marcus and Millichap. So I've sold commercial real estate for a multinational, publicly traded commercial real estate brokerage company, and as well as being a property manager. And I focus on helping others invest passively and build wealth through investing in real estate. My geographic area of focus is the what I like to call the West Midwest, basically Missouri, Kansas, Oklahoma, and Arkansas. So that western side of the Midwest, and that is our area of focus. There's a lot of opportunity there in those West Midwest markets. All right, so close. Why? All right, close. Why? All right. So why does it matter to understand how you as a passive investor get paid? Well, it's not just about owning real estate. It's about understanding the entire return profile. It's not just through cash flows or appreciation or tax benefits. It's all of them combined. And how do you understand each one of those factors when you combine them together? And many investors don't understand or don't know the right questions that they need to be asking to the sponsor that they're doing business with when they get ahead, when they decide they want to start investing passively in real estate. They just go like, "Oh, you did this, Mike Smith, with the other guy, Joe Jones. Should I invest in Joe Jones's deals? Well, they haven't failed me yet." And then, next thing you know, you're investing along Mike Smith and Joe Jones's deals, and you didn't even know where the property was, what was going on, how are you going to get paid, what's going like, how's the process work, how you ever get any returns. Basically, you're just like taking that money and putting it on black. Well, my objective is to teach you how to avoid the process of just putting it on black and wondering if you're ever going to get paid. So that is it. Today's goal is clarity and confidence. So you want to be confident when you go into these meetings with these investors, these sponsors, or anyone, and be able to ask the right questions. You know, in what, so, let's just start at the basics. Like, what is passive investing? Well, passive investing is, it is working alongside an experienced sponsor, somebody like myself, somebody who is experienced, has decades of experience. I mean, I guess I have decades of experience in real estate investing, and choosing to work alongside them. You do not have to swing hammers. You don't have to qualify for loans. You don't have to go through the process of hiring and firing property management companies, or collecting rents or any of that. You can come along for the ride with us as a passive real estate investor. And how do you do that? Well, you put in the capital. And then the GP, the general partners, the active partners, the experienced people in the room, we execute the deal. We execute the business plan. We make sure to purchase the right properties. We manage the process of owning the property along the way, which is quite honestly a very dynamic situation, because anything can happen. Tenants can choose to not pay. You can have some drunk driver run into one of your buildings in a snowstorm. Well, both have happened to me. Quite multiple. Well, the second one only once, but multiple times you deal with certain things. So you don't have to deal with any of that by working with an experienced operator like myself. And there are two main ways that you earn income or return on your investment while being a passive investor. We're not going to focus on the tax benefits of real estate investing. That's a whole nother webinar. We'll just do a whole nother webinar on that as well. But this is just to focus on how you actually get your money as opposed to how you benefit from tax return. So we're going to talk about distributions and profit splits. So here's how it works, everybody. So you have the main ways. We're not really going to focus on tax benefits. We're going to focus on distributions, profits from the sale, or refinance of the deal. That's really what we're going to do. So first, you have the cash flow of the property. That is after all of your expenses. So once you pay for CapEx, once you pay for taxes, insurance, your mortgage, your payroll, your utility bills, everything, all of your expenses come out. You finally have your total cash flow available, including your debt. So after you pay your debt, after you pay everybody, then you start being able to pay your preferred returns. So you pay your preferred returns out to the investors. So the investors get paid first. And what do they get paid? They get paid their pref or their preferred return. How we generally structure most of our deals is with an 8% preferred return. So if you were to invest, let's say, we'll have examples here in the upcoming portion of the webinar, but let's just talk about it in context. So if you invest $100,000, you should expect to receive a preferred return of 8% with reinforced capital. And so if you put in 100 grand, you're going to get 8,000. And then after that, the remaining profit, after all expenses are paid, all debts paid and everything, after that, and after you, the investor, receive your 8% on your invested capital, then that's when the general partners start sharing in the profits. So you, the LPs, receive or continue to receive your 70% of the profit split. The general partners split or receive their 30% of their profit split. That's generally how we structure our syndication deals, at least specifically for non-recourse deals. All right. What are distributions? How are they paid? Who do they go to? All the questions. And feel free to jump in and just interrupt me and ask questions. I'm totally willing to answer any questions that pop up in the middle. So, how are distributions paid? Well, usually we pay our distributions out quarterly. So, we have our property operational expenses after income. Remaining cash flow goes paid out quarterly. Quarterly, we send out our distributions, and the distributions are paid in accordance of first the preferred return. So if you are still owed preferred return from previous quarters that you didn't receive it, then those are caught back up first. And then after that, then the general partner starts participating in the upside of the deal. So typically it's paid quarterly. Some people pay monthly, but we do all of ours quarterly. Um, so how is it paid? Well, these are cash flowing real estate investments, or at least that's what our objective is. So it comes from the cash flow of the property. They are not guaranteed. I want to let you know the cash flow distributions from any property are not guaranteed whatsoever because all it takes from an operator standpoint, so that's who I am, all it takes is one thing, one single issue, one, you know, roadblock or one sewer lateral repair or one HVAC system replacement or one roof replacement that you have to do in order to disrupt your available cash flow for distributions. So it's not guaranteed. And there'll be lots of questions that we want to ask our particular sponsor at the end so that we can make sure that we understand how those distributions are made and what decisions are made in the middle.
Hey Lee,
All right. Yeah.
so when you're vetting investors, what does that conversation look like? And then also when it does happen, if it's happened to you, what does that conversation look like?
Yeah. So when I'm betting investors, I like to have a conversation with them first about their financial stability. I want to make sure that they are not relying on these cash flow distributions in order to survive. If they are, and this capital that they're investing into this deal is everything they have to live on, then they should not be investing in this asset class. They should not be investing there. Yeah. And I walk every one of my investors through each deal individually to explain the business plan, the property, and when they should hope to receive distributions and what those distributions look like. Be able to set expectations ahead of time as much as humanly possible.
Okay. And then have you had to have a hard conversation with investors? Like, oh, distributions aren't going to be paid out for some time?
I have, honestly. We've had a couple deals where we have never done a capital call, but we have had to suspend distributions because, well, there are multiple scenarios. But one, for example, our taxes increased drastically. I'm talking about 50% higher than what we originally estimated them to be. Um, it was unforeseen, but it essentially wiped out half of what we would have planned to distribute just because of taxes and insurance for a particular property that comes to mind. And what I do find is that when you explain the nuances of that with the investor, like why did our expenses go up? Why did our occupancy go down? Why are we not collecting as much money as we thought we would? To an investor, they understand, they get it. Most of them realize like this is a business, and sometimes you have good times, sometimes you have hard times.
A B
And
C
really, what
F G H I J K L M O P Q R S T U V W X Y and Z. A B C G E F G L L P Q R W X Y.
Sorry. Yeah, not sure. Yeah, we're good. We can keep going. All right. Ryan, did that cover pretty much everything? Or I can keep going into it if you'd like.
No, I think that was pretty good insight. Thank you.
Cool. Yeah, yeah. So yeah, general structure, preferred return, 6 to 8%. So they receive that split,
Do you have a
that
girlfriend,
fixed
bro?
return.
No, we had a boyfriend, but no girlfriend. He like, what the? He's gay?
One sec. Sorry about that. It's the problem with having publicly posted webinars. You get everybody. So, all right. So you have your preferred return. That's the returns you receive before there's any splits paid to the sponsor. Sponsors are the ones who are the general partners and do all the work, and sign on the debt and make sure that the business plan goes according to plan. All right. Then you have waterfall structures. I have not yet, I should say, specifically used tiered waterfall structures in any of my deals to date. So there are real estate syndication deals that you can choose to invest in that have tiered returns that adjust the amount of the split between the general partner and the limited partner based upon certain return metrics that you can achieve. So, like, for example, you can have, like, once you hit 80, you'll get a 70-30 split. Then once you hit a 20% return, it switches to a 60-40. Then once you achieve over a 15% return on your money, it might switch to 50-50. Those are very complicated and only meant for very sophisticated investors. So if you're a sophisticated investor and you deeply understand how that works, then by all means, feel free to pursue investments into real estate projects with tiered waterfall structures, but I recommend approaching that process cautiously. That's my suggestion. So let's take a deal as an example. So example, deal you invest or you have a preferred return of 8% on your over on $100,000. The math does work. So you have a simple amount. We were going to raise $1 million. Investor invests $100,000 over, and then over 5 years, or their preferred return is either received or accrues at a rate of $8,000 per year over 5 years. That would be like $40,000. Then after that, let's just say we sell the property. And that sale results in let's see, an $80,000 split. So an 80 cents on the dollar return on your $100,000 in capital. So that million earns an additional 800,000. Does that make sense? I'm kind of missing a number here, but $1,048,000 a year for 5 years. Then after you've received this 40 grand, if the property earns an additional $800,000 in probably appreciation, that would equal out to 70% of 80,000. So that would be 56,000 that goes to you, the limited partner. And so you would receive essentially 16,000 a year over 5 years, but it's really $56,000 in a lump sum. So your total return on your investment is $96,000 on your 100 grand over the course of a 5-year period. Does that track with everybody? Kind of following that process, how that works? I'm going to take that as a yes. All right. So several questions that investors commonly ask me when I'm having conversations with them about a deal. Okay, first of all, what if a deal doesn't hit pro forma? Or in a sense, what if a deal doesn't pay out the pref? Well, the pref continues to accrue. So it continues to accrue month over month over month over month until which time you eventually sell the property and you have to catch up on your pref or preferred return, that $40,000. If this hasn't been paid out on time on a quarterly basis, this 8 grand hasn't gone out quarterly over the last 5 years, well, guess what? you're you, the limited partner, owed that return before the syndicator, the sponsor, earns anything for their hard work. Well, I can tell you that that has occurred on a few, I shouldn't say several, a few of my deals in which we were not able to fully distribute the entire pref in time for sale. But when we did eventually sell the property, we were able to catch up not only on their full pref, but we were able to pay out their entire original return because the appreciation was actually greater than what we originally estimated it to be. All right, will I still get my pref? The answer is yes. You still get your pref before the sponsor receives any fees or any sort of profit share in the deal after the you close. Can I reinvest distributions? In our structure, we don't have the ability to be able to let investors reinvest their distributions. There are some funds that allow you to do that, but that's not how we do because we're deal by deal. And when do I get my capital back? Well, every deal is a little different. And specifically, you should review your deal metrics in the private placement memorandum. But we like to structure our deals where you get your capital back. My preferred way is through a refinance because that is a non-taxable event and we get to keep the property for the long run. That's my preferred way to do it. All right. So who's this guy with the AI created photo of the guy waving the red flag surrounded by smoke and mirrors? That's literally what I typed into ChatGPT. So let's just call him Fast Lane Larry. Fast Lane Larry. All right. Fast Lane Larry has no preferred return. He just has a straight split 50-50. I get to keep 50% of whatever's made, and you get 50% of whatever's made. Does that sound good? Handshake deal. Let's go. He's got his finger pointed at you and everything. Um, Other red flags you really want to look out for are when GPs get paid before you. So if they are taking their fees and their portions of the deal before you receive any money, then you really need to be that's when the red flag needs to go up. Vague waterfall structures or vague PPM docs. So if you don't understand within a 30-second conversation how with the sponsor of how you get paid, I would suggest you to run. So vague wall structures where you're saying to yourself, or they're saying like, oh, well, after you get 10%, then I get 20, and after you get 12%, I get 30, and after 15%, I get 50. Well, sounds good and all, but it also sounds extremely complicated. Extremely complicated, sounds very vague, and that's when a big red flag should pop up. No clear exit timeline. Okay, so I recently sold a deal, my very first syndication actually, and we said we were going to hold the deal for 5 years. We said 5 years, we're going to hold the deal, and we went through the process of trying to sell it early. Didn't work out. We ended up going through the process of selling it again. It did finally close, and we closed just in time to hit our exit strategy because we told, and we originally projected that we would sell in 5 years. So, what did we focus on and make sure we achieved is the sale of the property, the return of member capital, the catch up on the pref, and as well as the distribution of member return on investment uh, within that 5 years. We literally closed and sold the property, I think it was 4 days or 5 days after the 5 year deadline. So if there's no clear exit timeline, like, we might just own this thing forever, that's a big red flag. And you should probably think twice about doing that deal. All right. So, real world example of a deal that we have done before in the past, and how did it work out for our investors? Well, this is a snapshot of our original slide from a private placement memorandum, offering memorandum that we did in 2021 on the Park Hills apartments. So our original projected returns were on $100,000 was 8,000, 12, 13, and then through a refinance, the investors got back 100% return of their original invested capital. We were a little shy on this. We did, I think it was like eight, and eight, honestly. So we did our full pref return to all of our investors. We didn't overachieve it, but we did hit our full pref. And then all of our investors received 100% return of their original invested capital. We said 36 months, but it took us 40 months. So it did take, an extra 4 months to be able to get there. So what's the benefit of that? The benefit is that those partners got to be able to take that and redeploy their capital that they originally invested in this deal while still maintaining ownership of the real estate. And they could take that 100 grand and they can invest it into whatever else they want and then continue distributing year over year over year. Now, surprisingly enough, in year 4, which we are in right now, we actually are going to beat these numbers. That's where I'm really going to overachieve our cash flow distribution. So that's my intention, is not only to get our investors their 8% preferred return, but then also overachieve the annual distributions thereafter. And then, of course, sell somewhere year 10, which would be what, 2031. It's a long ways off to think about right now today. But yeah, I mean, I have no hesitation in believing that we will not only achieve, but overachieve those distributed cash flows in the following years thereafter. So, yeah, imagine buying a piece of real estate, cash flowing for the first 3 years, refinancing out all of your original money, and then just keeping it forever. It's a giant burr. That's what we like to do. That's our preferred business structure.
So why do you prefer to do the entire amount of capital back instead of just doing like half of it and then keeping more money in the deal? Because right, it would cash flow more. Is it because you said something about taxes earlier? Is that your main reason?
I wouldn't say that's the main reason. I would say that it's really just the concept of being able to say or know that you have zero financial risk left in the deal. That literally after this refinance, if we were to go to, war with China and the world were to come in, the deal were to fail, and oh my gosh, all that, everything were to fall apart, you didn't sign a loan. There were no risk whatsoever. So you received your cash flow and now you have 100% of your original invested money back. So I think it's the concept of the infinite return, which that's really where I've focused a lot of my time and attention is on achieving infinite returns. And that's, the only way you get there is if you get 100% of your money out.
Okay. So it's like a kind of a way of being risk adverse then.
I would say so.
Okay.
I would say being risk adverse is an approach towards that, especially considering we have non-recourse debt to where you can, literally after that, it's the house, you're playing with the house's money from that day forward. Nothing else really matters. All the money is pulled out of the deal.
And then I assume that also helps you scale as well, because now you can convince them to invest on the new deal and they have all their capital back that they originally invested, right?
That, of course, is always the hope, is that our limited partners trust that we've been successful and turn around and take that second round and reinvest it in the next deal, which we had several that chose to do that. I had a few others that said, no, I'm good. I'm going to go buy crypto with it or whatever. And of course, you can choose to do whatever you want with your capital, diversify it and invest it however you'd like. But we did have several that chose to come along with us on the next deal after this one.
Cool.
All right, and this is how we prefer to structure our deals. We prefer to structure our deals with a refinance in year 3 or 4, somewhere in the middle, and hold it for the long term. I like long-term hold deals because real estate is really an asset that's supposed to be held for longer terms. It's not something that's supposed to just be held for 2 or 3 or 4 years or whatever, because you don't ever really get to take advantage of the second best money you ever make in real estate. Who here knows what the second best money is you make in real estate? Obviously, number one's cash flow. Anybody want to
Appreciation.
guess? Oh man, so close. I mean, and it does coincide with depreciation.
Is it a principal pay down?
Principal pay down. When every single month you pay your mortgage with your tenant's money and your principal goes down. Appreciation's probably better than that, but it's still blue sky. It's still, in my mind, fake money because you don't know what your deal is going to sell for ever until you do, until you finally sign a piece of paper with a buyer who that says, I will buy your property for X. That is blue sky fake money. That is paper, returns. That is money that you don't actually have. You can't actually spend it. But I tell you what, you can do with principal paydown money. You can refinance that money back out of that deal again. You really can, literally. So, I like longer term hold deals. Those are my favorite deals. I like being able to do the infinite return structure. I like to be able to give our investors back their original invested capital after they've received their preferred return, plus some additional cash flows, which is amazing. And I hope to hit those every single time. That's my ideal structure. The secondary deal structure is a 5-year hold. We do 5-year hold deals as well on some of our more value add deals, the deals that are not as stabilized, the deals that need more money put into them, the deals that end up being deals that appreciate drastically, but they are, in many cases, harder deals because the 5-year deal usually requires a lot of displacement of tenants, which disrupts cash flow, which reduces cash on cash returns for investors, and it makes it harder for investors, harder to execute your business plan. So I prefer longer hold deals. We do shorter term 5-year hold deals. But over the last several years, I've kind of realized, my favorite flavor of ice cream is the longer term deal.
And
And I
then
feel like it's in alignment with our investors.
are you doing 20 because with the commercial loans, right? Can you do 20 or 30-year mortgages?
We
And which
haven't
ones are you
ventured
doing?
in, we're doing usually 10-year loans on our 10-year deals and 5-year loans on our five. And you can add supplemental loans in your 10-year deals. Or you can take out a 5-year loan and then plan to take out another 5-year loan on your second term of your total 10-year deal. But I have not done any 30-year loans on multifamily yet.
So you're doing those
There's like
shorter loans for most to get a
five
lot of
year,
that principal pay down?
yeah, like agency loans. That's mostly what we're doing is agency loans or bank loans. But
Okay.
if you want to go past 10 years, I think it might be 12. It's you have to go to like insurance companies or HUD or some sort of other bridge loan options, which I have not done. But you can, but you know, yeah, there are other loan options out there.
And then are you doing like interest only periods where you're only paying on interest, and how long are those usually for?
Yes. Normally we're doing IO periods, and historically it's been like 3 years of IO, 2 to 3 years.
Okay. Thank you.
Yeah, of course, all day. All right, what's coming up? So, we are looking constantly for new opportunities in the West Midwest. So, St. Louis, Kansas, Arkansas, Oklahoma, and we are expanding into self-storage. Would love to be able to have conversations with any limited partners or active partners who would be interested in partnering up and doing some deals together. That's actually why I do these, is to be able to have conversations with active and passive partners. So during our Q&A, you can scan the QR code and book a call with me if you'd like. But if anybody has any questions, I'd be happy to answer them.
What's your plans for
How
the
are
water or the Waterman Boulevard property? Are you doing 10 years?
That one, so I have let's see, I have a 10-year plan on that deal with a 3-year refi. So yeah, that one actually falls under that infinite return structure. But that one is actually, yeah, we decided ultimately to not syndicate that one and not partner. So we're just taking that one down in-house.
Bring up the value on that street so we can get the best out of our fix and flip.
Let's go. Yeah, that one is ultimately going to end up becoming like the deal that I give to my grandchildren, that kind of deal. Like that's
That's
what I'm
awesome.
hoping on
That's
that
awesome.
deal. Yeah, if I have any. If I don't, then it'll be my nephew, so I'll give it to them. And then they can do like the step up in basis when I die. I'm over 40 now, so like I have to think about the future.
Those are the best gifts, the stepped up basis.
Yes. Yeah. Yeah, that deal is going to be the one that just pays bills and goes to my children, grandchildren, nephews, whatever. Like I'll just never sell that deal. Just refi and get all the money out and move on.
That's awesome.
So, well, anybody have any thoughts? Final thoughts? Questions? I did just launch another Tours and Pours just before this. We're going to do it 1 week from Thursday. So on the 22nd of January, we're going to meet at Max in the Central West End on Pershing. So 6 o'clock, come out to Max. Would love to see you there if you're in St. Louis. All right. Well, I'm going to call this one closed. 45 minutes in. Man, we've had some long ones. We've had some short ones. This is probably a record, 45 minutes in. We've had some like 2-hour long webinars before. It's been great. But yeah, if anybody has any last minute things they want to add or ask questions, happy to jump in.
Congratulations on your new close. When you closing on that one, the 20 unit one?
On the 21st. I
Oh, very
hope,
good.
because I'm supposed to talk about it at Tours and Pours on the 22nd. So if I
Is
don't
it, is it,
close on time, that's going to be an awkward conversation.
is it in Missouri? Is it close to you?
Yeah, it's 2 blocks away from my house.
It's easy to go do your own property management, huh?
It's going to be great. I'll be the maintenance man all the time.
I
Be
love it.
driving around the Central West End in a rusty pickup truck with a weed whacker in the back and sweaty a wad of sweaty
You'll
$20
be in your
bills.
60s doing that. It's like, see that guy? That's that multi-millionaire guy. And then
That
a
guy's a
rusty truck.
millionaire. The millionaire next door. That guy.
Oh, I
No,
love it.
I mean, by then I'll be old and I'll have delegated it to some property management company by then, and I'll let them rob me blind at that point. I'll be happy to let them rob me because I'll have no debt.
Well, good luck, Lee. I hope that closes quickly. Oh,
I got what, 9 days, so we'll see. 50-50.
oh, very cool.
You know I always close on time.
You
I always
do.
close on time. Yeah.
You do. That's a nice little deal. That's a nice little
Yeah.
deal.
Oh yeah. Lifetime poll. Lifetime poll.
Exactly.
I wouldn't buy a 1970s property if it wasn't for that in the right location. Yeah.
Oh, that's a fact. Well, let me know when you get another big one.
Oh, it's coming. I got 3 more in the pipeline right now. We're underwriting. It's gonna be
All
great.
right. Very good.
Yeah.
All right. Well,
All
have a great
right.
week. Have a great weekend. Enjoy
Thank you.
Mexico. Enjoy
I
Mexico.
appreciate it. Sam and the entire audience. I will hopefully see you at Tours and Pours on the 22nd. If not, I'll see you for our monthly live webinar on the second Tuesday of every month. Thank you for attending and joining this month, and we'll see you again next time.
See ya. Have a
Thank
good night,
you.
everybody.
Have a good
Bye,
night.
everyone.
Take care, Lee.
Take
Thank you,
care.
Lee.
Bye-bye.